All right, so are you ready to kind of figure out what might happen in the U.S. stock market this week?
Mm,
It's going to be a crazy week.
yeah,
We've got inflation that just won't go away.
right.
Global tensions are heating up.
Uh-huh.
And then we have those company earnings reports.
Always
I
fun.
know. So much is happening the week of February 18th through the 21st.
Buckle up, right?
Yeah, definitely. It feels like we're walking into a bit of a minefield.
And you need a map, right? That's why we're here, to help investors understand all these different factors.
Exactly, how they all connect and what they might mean for your investments.
It's all about making sense of the chaos.
Right. Okay, so first up, we've got this whole situation in the Taiwan Strait. Tensions between China and Taiwan are rising, and markets really, really hate uncertainty.
Yeah, absolutely. Geopolitical instability is like a big red flag for investors.
It makes them nervous.
Big time. Like, remember back in 2022 when Russia invaded Ukraine?
Oh, yeah?
The S&P 500 tanked like 10% in just a few weeks.
So we could see something similar happen if things get worse in the Taiwan Strait.
Definitely possible. Investors could get spooked and pull out of stocks, looking for safer places to put their money.
A classic risk-off situation.
Exactly.
Okay, so history shows us this is a big deal. But what should investors actually be looking for to see how this might play out?
I'd say watch for any military actions or any signs that they're trying to cool things down through diplomacy.
Right, so we're looking for concrete moves. Got it. Now, on to another potentially explosive situation, inflation. It just won't quit, will it? It's still hovering around 3.5%, which is way higher than the Fed's 2% target.
It's definitely been stickier than a lot of people expected.
And that's got to be stressing the Fed out.
For sure. I mean, remember, they've already raised interest rates a bunch of times.
Like the Fed funds rate is now at 4.75% to 5%.
Right. And now everyone wants to know, will they keep raising rates? Or are they going to hit pause?
Everyone's waiting to hear what Fed Chair Jerome Powell says.
Uh-huh. And especially those FOMC minutes coming out on Wednesday.
Oh, yeah, those are going to be under the microscope.
Big time. They'll give us a peek into what the Fed is thinking. You know, like what they talked about behind closed doors.
Right, so it's not just about what Powell says publicly. It's about what the whole Fed seems to be thinking.
Yeah, exactly. We'll be looking at the dot plot to see what individual members are projecting for future rate hikes. And any signs of disagreement within the Fed, that'll be interesting too.
Right, the disagreements are sometimes more telling than what they agree on. You know, all this Fed talk might seem kind of technical and maybe even boring.
Yeah.
But their decisions affect everyone, not just Wall Street.
Absolutely. It's not just about stocks. It's about the whole economy.
Mortgage rates, business loans, jobs, it's all connected.
The Fed has a lot of power.
They do. Okay, so speaking of the economy, this market forecast we're looking at also mentions some key economic indicators coming out this week.
Right.
And these could give us a clue about whether the U.S. economy is heading for a slowdown or maybe even a recession.
We're watching a couple of manufacturing surveys closely, the Empire State Manufacturing Index and the Philadelphia Fed Business Outlook Survey. Both come out on Thursday.
Okay.
Usually these surveys tell a similar story about what's going on in manufacturing, but lately they've been painting different pictures. The Empire State Index has been showing more weakness.
Interesting.
Yeah, so we'll be watching to see if that gap gets bigger or smaller. That could tell us something about where the economy is headed.
Gotcha. So consistency or the lack of it, that's what we're looking for. Okay, and then there's the tech sector, which has been under the microscope lately, all that scrutiny around AI companies and just big tech in general.
Yeah, the regulatory landscape is definitely getting tougher for these guys. Remember what happened in Europe with GDPR?
Uh-huh.
Well, now it seems like the U.S. is starting to crack down, too.
Interesting.
It's all about whether this push for regulation actually leads to concrete actions, you know, like antitrust lawsuits or new AI rules.
So what could that mean for the NASDAQ, which is full of tech stocks?
That's the big question. These tech giants, you know, Apple, Microsoft, Google, Amazon, they've been driving market growth for years. But if regulation starts to hold them back, the whole market could feel it.
Like a domino effect.
Exactly.
Okay, so we've got geopolitical tensions, stubborn inflation, and now regulatory headwinds. It's a lot. Let's take a deep breath and try to break down the economic calendar for this week. See how these themes might actually play out.
Sounds good. We've got a data-packed week ahead.
Yeah, it's going to be busy. Tuesday's pretty quiet, but Wednesday's all about housing and the Fed. We've got housing starts and building permits data in the morning, which tells us about builder confidence and what they're planning. But the main event is the release of the FOMC minutes.
Oh, yeah, definitely.
As we said, those minutes will give us a deeper look into the Fed's discussions. What are they really thinking about future policy decisions?
Right.
Then on Thursday, we get a double whammy of important data: initial jobless claims and existing home sales.
Those tell us about the health of the labor market and the housing market. But Thursday is also a big day for company earnings. Alibaba, Block, Cooking Holdings, and Newmont are all reporting.
Wow, that's a lot.
But the one that's going to get the most attention, Walmart.
Walmart, the retail giant. Why are retail earnings so important, though?
Because they're a great indicator of consumer spending. And consumer spending, well, that's a huge part of the U.S. economy.
So when Walmart reports, what should we be paying attention to?
Inventory levels are key. If they're sitting on a lot of unsold stuff, that might mean consumer demand is weakening.
Oh, that's not good.
Right. And then we also want to see their sales figures. Are they beating expectations or falling short? That tells us about consumer confidence and how healthy the economy really is.
Okay, makes sense. And then Friday, we've got the Marquette Manufacturing PMI.
Right. That gives us a sneak peek at the health of the manufacturing sector, which can be a leading indicator of broader economic trends.
It's all connected. All right, so we have a pretty clear picture of the economic data coming out this week. Now let's talk about those analyst upgrades and downgrades. Can you just quickly explain what those are?
Sure. So you've got analysts at these big investment banks, Goldman Sachs, JP Morgan, and so on.
The so-called smart money.
Right. They're constantly evaluating companies and issuing ratings on their stocks, like buy, hold, or sell. An upgrade basically means an analyst is more optimistic about a stock. They might raise their price target, which means they think the stock's going to go up.
Gotcha.
And a downgrade, well, that's the opposite. They're less optimistic. They might lower their price target, signaling that they think the stock's headed down.
So it's kind of like getting a peek into what the experts are thinking, but investors shouldn't just blindly follow these ratings, right?
Oh, absolutely not. These are just opinions. It's important to do your own research and make your own decisions.
Always. Okay, so we've talked about the economic data, the regulatory changes, and those analyst ratings. Now I think it's time to game out some possible scenarios for the week ahead. This market forecast lays out 3 different outcomes based on everything we've discussed so far. Ready to play them out?
Absolutely. Let's do it.
All right, scenario number 1, inflation stays high. Let's say the economic reports come in hot, confirming that inflation is stickier than we thought. What kind of impact would that have on the market? Okay, so that's scenario 1, persistent inflation. What if those economic reports show that inflation is actually cooling down?
That's what everyone's hoping for, right?
Right. Scenario number 2, inflation moderation. What happens then?
Well, we could see a relief rally in the market.
A relief rally.
Yeah, like a collective sigh of relief from investors. And the sectors that might benefit most, probably tech and consumer discretionary.
So we're talking companies like Apple, Microsoft, Amazon, all those big names.
Yeah, they could definitely bounce back. But also think about some of the smaller, more innovative tech companies. They tend to be even more sensitive to changes in interest rates.
So if the Fed signals they're going to pause those rate hikes, those smaller tech companies could really take off?
Exactly. Because if the Fed eases up, investors will be more willing to bet on those high-growth companies again.
Makes sense. Okay, fingers crossed for scenario 2. Now let's face the scenario we're all kind of dreading, scenario number 3. Geopolitical risk spikes. What happens if things get really bad in the Taiwan Strait?
Ugh, nobody wants to think about that.
I know, but we have to be prepared.
Right. So if that happens, we'll probably see a classic flight to safety.
Meaning?
Investors will dump riskier assets and pile into safe havens.
Like what? What are those safe havens?
U.S. Treasury bonds, for sure. Gold is another classic safe haven.
Okay.
And even the U.S. dollar, because it's considered a safe haven currency.
So bonds, gold, the U.S. dollar, and what about specific sectors? Would any of them do well in that kind of environment?
Defensive sectors are usually the ones that hold up best during times of uncertainty.
Defensive sectors? Like what?
Healthcare, consumer staples, things people always need no matter what's happening in the world. Utilities, too, because people always need electricity and water.
Right, the essentials. So if things start to look really bad on the geopolitical front, those are the sectors to consider.
Exactly. It's all about managing risk and protecting your capital when things get dicey.
Smart. So we've explored those 3 scenarios: persistent inflation, inflation moderation, and geopolitical risk spikes.
A lot to think about, right?
Yeah, for sure. But now let's shift gears a bit and talk about what investors can actually do with all this information. Because knowing what to watch for is important, but knowing how to react is where the real skill comes in.
Absolutely. It's all about turning knowledge into action. That's where things get interesting.
Right. So let's say I'm listening to this and I'm thinking, okay, this is all great, but what should I actually be doing with my portfolio right now? What's the first step?
Well, you got to be honest with yourself about a few things. Your risk tolerance, your investment goals, and your time horizon.
Okay.
There's no one-size-fits-all answer here. What works for someone who's retired and just wants stable income is going to be totally different from what works for someone in their 20s who's investing for the long haul.
That makes sense. So let's start with those risk-averse investors. You know, the ones who really prioritize protecting their capital and minimizing losses. What's your advice for them this week?
This might be a week to focus on preserving what you have rather than trying to make big gains.
So play it safe?
Yeah, kind of like battening down the hatches before a storm.
Okay, batten down the hatches. What does that actually look like?
Well, U.S. Treasury bonds are always a classic safe haven. They're backed by the full faith and credit of the U.S. government, so the risk is super low. You could also consider diversifying into gold, which tends to hold its value pretty well during times of uncertainty.
So bond the goal for the risk-averse crowd. Got it. Now, what about investors with a bit more of a stomach for risk, the ones who are in it for the long game and can handle some ups and downs along the way? What are some strategies they might consider?
For those investors, this kind of volatility can actually create some interesting opportunities.
Opportunities.
Yeah, remember those scenarios we talked about? Each one points to different potential winners and losers.
Right, like energy and materials if inflation stays high, tech and consumer discretionary if it goes down.
Exactly. So the question is, how do you position yourself for those different possibilities?
Right, because if we had a crystal ball, this would all be a lot easier.
Haha, yeah, no kidding. Unfortunately, nobody knows for sure what the market's going to do. That's why diversification is so important. Don't put all your eggs in one basket.
So even if you think inflation is going to stay high, you wouldn't recommend going all in on an energy stocks?
Nope. It's about tilting your portfolio, not completely flipping it upside down. One strategy you could consider is sector rotation.
Sector rotation.
Yeah, basically you shift your investments between different sectors based on which ones you think are going to do well in the current environment.
So if you think the inflation is here to stay, you overweight energy and materials. And if you think it's fading, you shift more towards tech and consumer discretionary.
Exactly. You're like a market chameleon adapting to the changing colors.
I like that. Another strategy I've heard about is dollar cost averaging.
Oh yeah, that's a classic.
Can you explain that one for folks who might not be familiar?
Sure, it's basically investing a fixed amount of money at regular intervals no matter what the market is doing. So instead of trying to time the market perfectly, you just stay consistent.
So you're taking the emotion out of it, just sticking to a plan.
Exactly. And it helps you average out your purchase price over time, which can be really helpful when the market's volatile.
Okay, so that's dollar cost averaging, and then there's hedging, right?
Yeah, hedging is another tool in the toolbox.
But that was a bit more advanced, isn't it?
It can be, yeah. Basically, hedging is about taking a position in one investment to try to offset potential losses in another investment.
So like if I'm worried about the stock market crashing, I could buy something else that would go up if that happened.
Yeah, exactly. For example, you could buy put options on the S&P 500.
Put options, those give you the right to sell a stock at a certain price, right?
Right. So if the market tanks, your put options become more valuable, which helps offset some of your losses in your stock portfolio. It's kind of like insurance for your investments.
A safety net. But you're right, options can be complicated.
Definitely. You got to know what you're doing. But for experienced investors who understand the risks, hedging can be a really valuable way to manage volatility.
Okay, so we've talked about some broad strategies for navigating this week, but let's get down to brass tacks. What are some specific trading ideas based on those market scenarios we discussed earlier?
Love it. Let's get tactical.
Okay, so let's go back to scenario number 1, persistent inflation. What are some assets or sectors that might shine in that environment?
As we talked about before, energy and materials tend to do well when inflation is high.
Because of rising prices for oil, gas, copper, all those commodities?
Right. Those higher prices can translate into bigger profits for companies in those sectors.
So we're talking about companies like ExxonMobil, Chevron, Freeport-McMoran.
Exactly. Or you could get broad exposure to those sectors through ETFs like XLE for energy or XME for metals.
ETFs, those are baskets of stocks, right?
Yeah. So instead of picking individual stocks, you're basically investing in the whole sector.
Smart. Okay, now what about scenario number 2, inflation moderation? If inflation starts to cool down, what are some potential plays?
That's when we could see growth stocks come back into favor, especially tech.
Because those companies got hammered last year when interest rates were rising, right?
Exactly. But if the Fed signals they're going to pause those rate hikes, growth stocks could really take off.
So are we talking about buying Apple, Microsoft, Amazon again?
There are definitely options.
Okay.
But don't forget about those smaller, more innovative tech companies. They could see even bigger gains if sentiment shifts.
So maybe some cloud computing companies, cybersecurity firms, or those metaverse companies everyone's talking about.
Exactly. Those companies have the potential for huge growth if investors get confident again.
Okay, tech is on the radar if inflation cools down. Now, what about the scenario we're hoping to avoid, scenario number 3, where geopolitical risks spike? What are some ways to protect your portfolio if that happens?
Well, if tensions in the Taiwan Strait escalate, safety and stability are going to be the name of the game. Investors will likely flock to things like U.S. Treasury bonds, gold, and the U.S. dollar.
Those classic safe havens.
Yep. And in terms of sectors, defensive sectors are usually your best bet. Healthcare, consumer staples, utilities, those tend to hold up better than others during times of uncertainty.
Because people still need those things no matter what's happening in the world.
Exactly. It's all about adapting your strategy to the current environment.
I'm sensing a theme here. It's not about predicting the future perfectly. It's about having a plan for different possibilities.
Couldn't have said it better myself. You got to be prepared for anything.
And if you're not sure how to do all this, don't be afraid to get help from a financial advisor.
Oh yeah, a good advisor can be a lifesaver.
They can help you figure out a plan that aligns with your goals and your risk tolerance.
Absolutely, because everyone's situation is different.
Okay, so we've covered some specific trading ideas tied to those different scenarios. But before we move on to the last part of the show, where we'll talk about some resources and tools for investors, anything else you want to emphasize?
Yeah, I just want to reiterate that these trading ideas are just that, ideas. They're not personalized investment recommendations, and they don't guarantee you'll make money.
Right, this is not financial advice.
Exactly. Everyone needs to do their own research, understand the risks, and make decisions that are right for them.
Informed decision-making is key.
Yep.
All right, well said. We'll be back in just a bit to explore those resources and tools that can help you stay informed and make those smart investment decisions. Welcome back to the show. We've talked about all the things that could move the market this week and some strategies to navigate the ups and downs. But now, let's get practical.
Yeah, let's give our listeners the tools they need to stay informed and make those smart investment decisions.
Think of it as your investor toolkit, everything you need to cut through the noise and figure out what's really going on.
It's about empowering yourself as an investor, taking control of your financial future.
I like that. So let's start with the basics. Where can people go for reliable market news and information? There's so much out there, it's hard to know who to trust.
Yeah, it can be overwhelming, but there are some great sources out there. For solid, in-depth coverage, I always recommend those classic financial news outlets.
You mean like the Wall Street Journal, the Financial Times, Bloomberg, Reuters, those kinds of places?
Exactly. They have teams of experienced journalists and analysts, so you know you're getting quality information.
They're the heavy hitters, but what about something a little more digestible for the average investor? Someone who doesn't have all day to read those dense financial reports.
Oh, there are plenty of options for that too. Websites like Seeking Alpha, Investopedia, Morningstar, they do a great job of explaining things in a clear, concise way.
Okay, those are good ones.
And then there are apps, of course. For real-time market data and personalized news feeds, you can check out Yahoo Finance, StockTwits, even Robinhood.
So whether you prefer to read, listen, or watch, there's something for everyone.
Exactly. You can get your information fix however you like.
Now let's talk about data. We've mentioned a lot of economic indicators and data releases. Where can people actually track all this stuff?
For the economic calendar, the U.S. Bureau of Labor Statistics website is the best.
The official source?
Yep, it has all the release dates and times for all those important economic reports, inflation, jobless claims, manufacturing surveys, you name it. And then for market data itself, a good charting platform is essential.
So you can see those stock prices moving in real time.
Exactly. There are some great free options out there like TradingView and stock charts. They let you track prices, create your own charts, even test out different trading strategies.
Okay, so we've got news and data covered, but what about research? Let's say I want to really dig into a particular company before investing. What resources would you recommend for that?
If you want to get into the nitty-gritty, the SEC's EDGAR database is a goldmine.
EDGAR.
Yeah, it's where publicly traded companies file all their official documents, financial statements, earnings reports, information about their management team, all kinds of stuff.
Wow, sounds pretty comprehensive. But is it user-friendly?
It's designed for public access, but I'll admit it can be a little overwhelming at first. Luckily, there are websites like BAMSEC that make it easier to search and analyze those company filings.
So EDGAR is for the serious researchers.
For sure, but if you just want a quick overview of a company's financials, you can check out websites like Yahoo Finance, Google Finance, or FinViz. They give you a nice summary of the key metrics, revenue, earnings, debt, valuation, all that stuff.
So you get a quick snapshot before you decide whether to dig deeper.
Exactly.
You know what I think is a really valuable resource that people often overlook? Investor relations websites.
Oh, those are great.
They're like a direct line to the company.
Right. Most public companies have a section on their website specifically for investors.
You can find presentations from earnings calls, transcripts of investor conferences, sometimes even videos of the CEO talking about their strategy.
It's like getting a sneak peek behind the curtain.
And they often have FAQs that answer common questions from investors. It's definitely worth checking out. Now, we can't forget about social media, right?
True.
Platforms like Twitter and StockTwits can be great for real-time commentary and analysis. But you have to be careful, right?
Oh, yeah, for sure. There's a lot of noise and misinformation out there. You got to be selective about who you follow and what you believe.
Always double-check your sources. Don't just trust everything you see.
Exactly. Stick to people with a proven track record and always do your own research.
Solid advice. Okay, one more resource I want to mention, especially for new investors, online learning platforms.
Oh, yeah, those are fantastic.
Platforms like Khan Academy, Coursera, Udemy, they have tons of courses on investing, from the basics all the way to advanced trading strategies.
And you can learn at your own pace, often for free or pretty cheap.
It's a great way to learn the ropes and build your confidence as an investor.
Absolutely. Financial education is so important.
Okay, I think we've armed our listeners with a pretty solid toolkit.
Yeah, they're ready to tackle the markets.
But before we wrap up, I want to leave everyone with one final thought.
I'm listening.
Investing is a journey, not a destination. It's all about continuous learning, adapting to new information, and getting better over time. Don't be afraid to make mistakes along the way.
That's how we learn.
Exactly. Embrace the process, stay curious, and never stop learning.
Well said.
And on that note, we'll wrap up this episode. Thanks for joining us, everyone. And remember, the best investment you can make is in yourself.
Happy investing.